Welcome to June's trading strategy session. I'm Scott Gamm. This month marks the 8-year anniversary of the end of the Great Recession. That's right, June 2009 was the official end date, but of course high unemployment and lackluster growth persisted for years after that date. 8 years later, just as things are starting to get better and the Federal Reserve feels comfortable enough to take its foot off the accelerator, are we close to the next recession? Over the next hour, we are joined by an incredible panel of market pros. Let's introduce you to everyone. Peter Tchir is a fixed income expert and managing director at Green Capital. He's also heading up TheStreet's new fixed income product, Income Seeker. Douglas Borthwick is the head of foreign exchange at Chapter. And Sarge Guilfoyle is a market expert and former NYSE trader. David Yoe Williams is a commodities and gold expert and principal at Strategic Gold. And guys, welcome to all of you. It's good to see everyone. I want to start off with the folks who think that a recession is going to come sooner rather than later. Peter, that's you, as you wrote in your column on TheStreet.com. How bad will the next recession be and when will it come?
I don't think it's going to be a deep recession. I think it'll be fairly shallow and fairly short, but I think it's coming sooner rather than later. I think you're starting to see it in some of the economic data. You see the City Economic Surprise Index, that's fallen precipitously lately. And you talk to people, you're out there in the real economy, you're starting to see auto slow down, business travel slow down. There was a lot of excitement about the new DC and everything that was going to be delivered. And as that gets delayed, I think you're going to see a pullback.
Okay, so you said soon. Can you put a time stamp on that? It was 6 months, 1 year, 2 years?
We may well already be in the early stages of that type of recession. If you go back even to 2007 and 8, we were in a recession before anything was called. So I think we're in that slowdown kind of now or very, very shortly.
All right, and David Yoe Williams, I mean, you also in your column were a little bit sounding the alarm. What do you think?
I agree with Peter, but I'm more on the fringe. I think that we're not going to have a mild recession. I actually think that we're going to have a very deep recession once it occurs. I think that since 1987, actually, that the Fed and Fed intervention has been going on to lessen the effects of any kind of recession that we've had, and I think that cumulatively that is going to catch up to us, and when it does, it's going to be, I think it's going to be extremely serious.
And PIMCO actually sees a 70% chance of a recession by 2022. Do you agree with that?
Oh yeah, 2022. We're in Doug Borthwick. I think I'm far more in the camp that says it's going to be fairly soon. Certainly within a year, but I think maybe before year's end, maybe before 2018, we're going to start seeing some very serious signs of pullback and recession.
But Doug, you would disagree with David and PIMCO. You see a recession coming a little bit later, 2024.
Well, I think of recessions or growth or GDP as being a concept of volatility. And there's very little volatility right now. There's very little volatility because central banks are very, very involved, not just in economies, but also in markets. Who's the biggest buyer of equities these days? Well, some would argue that central banks are big buyers of equities. At the same time, central banks are a big buyer of fixed income. When that's the case and central banks are really running the market economy, it's very hard for you to see the big swings we saw either in GDP to the upside or to the downside. So I think that for us to really see movement in the economy in terms of large negatives or big positives, you really have to wait until the Federal Reserve's balance sheet has rolled off. And I think that's maybe 7 years down the road. Maybe in the meantime, you get very slight recessions, down 0.1 here or there. But the reality is you're not going to see the huge down 3% or the up 4% for quite some time, at least until volatility picks up, which will only pick up when Fed balance sheet or ECB balance sheet or BOJ balance sheets are significantly diminished, and that's not going to happen for about 7 years.
And we're going to talk a lot about the balance sheets in a moment, but first I want to get to Sarge. I mean, to this point of potentially waning central bank intervention, I mean, what does that mean?
Well, let's start at the beginning. Peter mentioned the City Economic Surprise. That's 100% right. Since May 1st, we've seen about 30 economic data points, including important ones like inflation, retail sales, employment, payrolls, participation, all disappointing, either coming negative or actually disappointing. So there's no doubt the economy is slowing somewhat. As we move forward past this June rate hike that we expect, the Fed is going to be put in a position where some of them might not be so loyal to the trajectory they've been putting forth. They might actually, you might see Fed meetings where some people are hawkish and some people are dovish, not the united stand that we've seen for so long. When you get that, we'll get your volatility. That's when things will get a little dicey here in the U.S. that's when markets will start fluctuating, and that's when we'll see just how secure we are, up or down 3 or 4%.
But this point that central banks are driving the markets, I mean, Sarge, when you look at stocks like Nvidia, Walmart, Apple, Take-Two Interactive, I mean, would you attribute those gains to central banks? No, it's really these companies that are driving the markets.
No, earnings have been sharp now they've been improving for 3 quarters. The last quarter was very good. The second quarter is estimated up another 10% year over year. So yes, earnings drive stock price. So we do have stronger stock prices, although valuations are higher than they probably should be. There is some fundamental basis for it. It's not like these firms aren't making money. It's not like healthcare firms and the discretionaries and the staples aren't doing better. These firms, to a large degree, let's leave the retail guys out of it, but they are doing better. So there is a fundamental basis, but there is no doubt that as long as the Fed is reinvesting in the balance sheet, well, then they really can't go too far. So for now, although a recession is not a far-fetched dream, we can wander into recession within a year. It wouldn't blow my mind. But how much of a hit would equities take if that happened? They might not take that as severe a hit as you would think.
Well, and Peter, do you think the markets are kind of distorted, right? We have all these asset classes moving in the same direction up, right? Bonds, stocks, gold, Bitcoin. I mean, what's your take here?
I kind of view the market right now as kind of being supported by a 3-legged stool. You've got, FANG, or more broadly tech, being very, very supportive. And you saw, just yesterday when the FANG stock sold off near the end of the day, there was a, Twitter blew up. There was a lot of concern about that. So I think that's one leg of support. The other leg of support has been the fact that bonds and equities have been behaving very nicely. So on days equities are up, bonds are off a little bit. On the days equities goes down, bonds are rallying strongly. So a lot of people are able to manage their portfolio, and you've seen VIX very sedated, we've been under 10 a lot. That to me has been the other leg, and this perception of liquidity. So there's this perception that you can sell what you want when you need. Maybe it's partly driven by the ETFs, maybe it's because there's this liquidity. I think any one of those legs could be tested where you start seeing, I think the worst case scenario for US markets right now is yields start pushing higher, dragging stocks lower, pushing VIX higher, and then you can get into a bit of a vicious cycle where those lead to a reasonably quick and painful sell-off.
But what do you guys make of the 10-year, which is now what, 2.1, which is actually lower than where it was in November 2008? I mean, isn't that worrisome in itself?
To me, this has really been a part. I think there's a risk parity strategy. Bridgewater's famous for it, developed in late 80s, and people are saying, I think, buying VIX has not worked. Hedging with options has not worked. The one thing that has worked is you own equities, you own long-dated bonds, and that's worked very well since Brexit. It was extremely, that caught a lot of attention post-Brexit. It caught more attention post-Trump. You saw Putnam launch some funds. You've seen some inflows into other funds. People are gathering towards this risk parity, which in its simplest form is buy equities, buy bonds. So I think that's why both have been going up in tandem, and I think that's why that risk to that cycle breaking could be very ugly.
Okay, but can this cycle completely be disrupted by the balance sheet? You guys were talking about the Fed's balance sheet before. David, what do you think?
I think it absolutely can. I think it goes to the question of, Doug and I were talking about earlier, it goes to the question of the trust in the Fed and trust in the system itself. So at least since Alan Greenspan, the Fed has been on a pedestal. Now it's starting to come off its pedestal a little bit in the last, let's say, 6 to 8 months. But the Fed has been on a pedestal where everyone basically watches the Fed, and whatever the Fed does, you follow, because that's where you're going to make money. So that goes to Peter's point that says, okay, equities have been going up, bonds have been going up. That's because basically the Fed is putting that is not just our Fed, but the ECB, the Bank of Japan. They are flooding the system with money, and those monies are going into risk assets, and those assets are evaluating in price, are going up in price. If that's the case, at some point in time, that cycle can be broken. I am of the belief that when it doesn't happen until it happens. So to try to predict when it's going to happen or something is kind of a fool's game. But that doesn't mean you shouldn't start to prepare, because obviously 8 months into a expansion is a very long time historically. And then if you go back 8 years, if you go back even further than that and go into what actually happened in the last couple of recessions and how they were stopped through Fed intervention, it's incredible how the system hasn't. In the system we live in, under the capitalist system, it hasn't been able to reinvigorate itself, rejuvenate itself. It's just the bottom points have been the bottom points have been stabilized by the Fed, and then we've moved forward from there. At some point in time, if the Fed loses control or if central banks lose control, that's over with, and it's Katie bar the door. You don't know where those levels are anymore. And as being in equities for years and years, I just think it's the overbought, overvalued syndrome is incredible right now, and the risk is so overlooked. And since the 2008 recession, 93% of risk assets, equities, have been fueled by the Fed, by Fed monies coming in. So if that's the case, it goes to Doug's point that says, okay, how do you take that off the balance? How does that come off? How does that debt come off in general? It's not just Fed debt, but it's debt in general. And if it's just slowly downgraded over 7 or 8 years, that could be I think that's a Goldilocks scenario. I think that's fantastic. But I don't necessarily ascribe to the view that that's what's going to happen.
Well, let me ask this, though, because the Fed's balance sheet is at $4.5 trillion. So let's say we go down to $3 trillion. Is that an accurate?
$4.5 trillion is, think about that. That's incomprehensible. How much is $4.5 trillion?
Right. So if we go to $3 trillion, we're still going to have 10, 11, 12 trillion dollars on global central banks' balance sheet across the world. Isn't that supportive for equity,
And you're going
Sarge?
to tighten monetary policy away from that too, right? If you listen to John Williams and these other guys, I mean, not only are they going to manage the balance sheet, are they going to cut it in half, but they're going to take the Fed funds rate up another point and a half.
Right.
But any shrinking of the balance sheet by 30% is equivalent to raising rates by a certain amount as well. So one sort of moves with the other. If you look at this, the stock market versus the Fed's balance sheet, we've all looked at that chart before, and you say, well, I wonder where the money's coming from. Well, that's it. So if you take some of that money out, well, then what you'll see is you'll probably see volatility go up by 30% because now the balance sheet's been decreased by 30%. I think that, but you have to, as you reduce the balance sheet, volatility is going to move up and down. We'll see, maybe higher highs, or maybe lower lows, but certainly you'll get the volatility back in the market that right now doesn't exist. Because you may feel like you're in a free market because you see much better earnings in this stock or that stock, but I think that the reality is when central banks own 30% of all outstanding government fixed income, it's not really a free market anymore, is it?
Well, but Doug, for the dollar, though, I mean, there's worry, though, that raising interest rates and shrinking the balance sheet is kind of a 1-2 punch for the dollar in terms of upward pressure.
In terms of strength of the dollar, sure.
In terms of upward
but
pressure.
I think what you're seeing is that the Fed certainly has gone out, or not the Fed, but the U.S. government right now, and Trump for sure has gone out and said, look, we want a weaker dollar. The way we make the U.S. more competitive is having a weaker dollar. Now, that's a different mantra from what you're hearing elsewhere, where most folks come out and say, oh, the dollar's weakening because nobody likes Trump. Well, I think that's completely incorrect. From day one, he's talked about making the U.S. more competitive. We've sat here and said, look, U.S. wants to have them more competitive. They have to weaken the dollar. Sure enough, the dollar's gone from 104 against the euro up to 112.70 as we're sitting here. The dollar is moving in the direction that Trump wants. So he doesn't look at this and think, oh, goodness me, the dollar's weakening. This is terrible. He's thinking this is great because it's great for America. It's great for competitiveness.
The ECB is giving them a hand too here. I mean, they're talking about tightening monetary policy at the same time. So that's a gift. Why wouldn't you take it? Why wouldn't you take a cheaper dollar?
Yeah, what are you expecting from the ECB's meeting on Thursday?
I don't think they're going to do anything just yet. I think you give them a few months. If their economy stays on the path where it can walk on both legs, well, they're probably going to knock down QE a little bit. They maybe take it down from 60 billion down to 40 billion, maybe 10 billion a month, something like we did here in the U.S. They do need to start to get the ball rolling in this area. I mean, they've been far more aggressive than has the Fed, at least of late. I'm sure they attribute the recent success in their economy to that, but like we saw here, the success is much smaller than the push into extraordinary measure.
David?
So why wouldn't, I'm going to the question of why wouldn't you want a weaker dollar? I'm not necessarily disputing that they want a weaker dollar, but why wouldn't you want a weaker dollar? Because then our dollars don't buy as much. So as a citizen, when I pull $10 out of my pocket, I don't want to buy $9 worth of goods and services. I want to buy $10 worth of goods and services. So when you go down that path to start weakening it, that is a slippery slope. You can lose control very, very quickly, and I think the Fed has been they've had tremendous control, and that last month we talked about hubris. I think they have gained a hubris that is incredible, and I'm of the opinion that it's about
respond to that.
Yeah.
Well, let's look at Middle America.
Okay.
Middle America would love to have that $10 in his pocket and get the 9. But to get Middle America working again, he needs to understand that he can that on the world he's not 30% more expensive as an employee for multilateral corporations, multinational corporations. So in order to make him available and cheap enough for him to be able to be employed, so he can then start paying taxes into the U.S. and also then have his $10 to go on vacation somewhere, he needs to have a job. And to get that job, we have to make America cheaper as a place for people to set up plants and then produce things. And you can't have that as the dollar strengthens every year by 10% because he becomes more expensive by 10%. You have to have it weaken. There's no surprise that every country in the world goes out there to try to weaken their currency, except for the U.S.
Right.
So we set up a trade thing with Mexico like NAFTA. Maybe dollar Mex is trading at 3 to the dollar, and now it's at 12.
But Doug, don't you
Or
think that
18.
the euro is gaining steam against the dollar because the gap in policy between the Fed and the ECB is shrinking?
Well, the gap is obviously shrinking, the yield differential is shrinking, but on top of that, no one's talking about Greece anymore. And even though we'll all agree, nothing's really changed in Europe, it's not in the radar anymore on CNBC or on TheStreet every single day where people are talking about Greece, what's going on in Italy. People aren't thinking about that. Now they're thinking about Trump. So they're thinking about Trump, and Europe's getting a free pass here, so you see this sort of move up again. No one's buying the euro right now thinking, oh my goodness, what about Greece? Greece is only 2.3% of the overall GDP of all of Europe. I don't understand why people ever worried about it.
The dollar's not really weak either. I mean, we're talking about
I know,
96, 97
that's
DXY. We were talking about an 80 DXY a few years
Right.
ago.
Right.
Okay.
So the dollar hasn't weakened that much. Sure, we've had a little bit of a move, 5 to 8%, pretty much across the board against most currencies. But I'd expect to see another 10, 15% of weakness before we really start it affecting the U.S. But also, a manufacturer won't set up a plant in the U.S. unless he understands that this isn't a short-term phenomenon, but it's something that maybe the dollar weakens by 25% from its highs, and then it sits there for a while. Because when you open up a manufacturing plant, when you hire workers, you expect to hire them for the next 5, 10, 15, 20 years. You can't sort of hire them and then suddenly become too expensive
Well,
for
you
you
expect, though, to hire them
do it.
because they're building something or making something people want to buy. And I think that's the concern right now is there's a slowdown in purchasing. There's a big growth, I think, in terms of experiential. So you're seeing, again, whether it's the hotel industry, corporate sales are going down, retailers using hotels more. They're getting more traveling. You're getting China travel. I think the purchase of things continues to decline. I think there's less interest in that. So even if we create this cheaper dollar, I'm not sure that it leads to this great economy where we're building and manufacturing stuff
Maybe not a
in a
great
world
economy,
that wants less.
But there is somewhere to go. I mean, you can go to small caps in a situation like that. You get along your Russell 2000 names or your Russell 2000 ETFs.
But that's been doing very poorly, which is one of my points that
That's
concerns
been
me
doing
right
very
here.
poorly, but if there is a belief that we will have a more domestic economy, those stocks won't do poorly.
All right, I want to talk about the euro more in our next segment when we talk about how to recession-proof your portfolio. But one more question on this point about the recession. The unemployment rate is at 4.3%. It was also at this point in 1965, January 1999, and October 2006. After all these times, something bad happens. You know where I'm going with this. The Wall Street Journal had a great article on this. Is there any historical context that is relevant when I talk about those 3 days?
Absolutely not. All right.
Different times.
Not just that, but here you have a very low participation rate, not because women are out of the workforce, but because less people are working. On those other days, except for 2006, well, almost half of our population wasn't looking for a job. They were home either mothering or wifing or doing something like that. So they weren't part of the statistics. Now the statistics are totally different. The unemployment rate of 4.3% is obviously low. It's not realistic. Gallup has it at 5.5%. The underemployment rate of 8.4% is obviously low. Gallup has it at 13.9%. So you might have been dealing with truer statistics in 1965 than you are now, which paint a rosier picture than we actually have. So I don't think there's much of a...
Well, that's a good point. I mean, David, you agree that the unemployment rate is 4.3%?
I usually don't agree with Sarge, but in this point, I 100% agree with him that I don't think the employment rate or the unemployment rate has much bearing as far as whether we're going to go into a recession sooner or later. I think it has far more to do with debt, Fed policies, the actual economy itself. And I do agree with Sarge. Those statistics are so skewed now that, and they have been for several years.
Plus, those rates are low on the backs of people who are working for $9 an hour for 29 hours a week, not for guys or gals making $70,000 a year in an office. So it's a different time, and the jobs are not as desirable as they once were.
Absolutely. All right, I want to move on to our next segment. We talked about the two most pressing questions on this topic. When is the next recession and how bad will it be? But now let's talk about what you can do to prepare for the eventual recession, because whether it happens in 1 year, 5 years, or 10 years, you want to be prepared. So Sarge, I'll go to you on this. What should you do? How do you recession-proof your portfolio?
Well, there's no way to completely proof your portfolio, but you know what? Defense wins championships. So if you get the feeling that we might be going into recession, and you know what, I think it could happen as soon as early next year, maybe as far as 2020, like 2022, like PIMCO said.
Right.
I think that's pretty safe that we'll have one by then. But that's when you want to be in your dividend yielding names. That's when you want to be in your utility sector. That's when you want to be in staples. That's when you want to buy Dave's Gold, and you're going to want to be long treasuries at that point.
Well,
because you know they'll support them.
In the PIMCO report I mentioned earlier, they are building up their cash positions so that they have some dry powder during the next recession to get stocks and bonds at a discount. Peter, from a fixed income point of view, how do you recession-proof your portfolio?
I think for now you can continue to own some treasuries or global sovereign debt. I think they're in pretty good shape. I think yields are low, but there's still support. You've got the central banks buying them. If we get any sort of hiccup, the central banks will very quickly shift from being hawkish to very dovish, as Doug said. So, and I think you can do some of that. I do think you want to avoid, big global oil plays, big global energy plays, things that are really relying on a robust economy. At the same time, I think you can look for areas that will do well if become very domestic focused. So, pipelines I continue to think are an interesting asset here. You get some yield play, you've got, strong support from DC, and we're going to try and be a little bit more insular, I think, so that works. I would eye the banks. I'd want to take a look at the banks, but I think the banks probably have another good leg down before they become interesting.
Sarge, do you agree with that?
Well, I was shaking my head when he mentioned the banks. As long as the yield curve stays the way it is, you don't want to be in a bank. I sold almost all my bank holdings already this year. I'm just long key banks. I think it's a good stock on valuation. I'm still long some Citi, but a very small amount. The spread between the 2 year and the 10 year is now down to what, 0.84 or something like that. I don't want to buy another bank stock until it's even approaching 1%. So until there's some margin in banking, I don't play it.
So the two things I think to look for, and I think equity guys tend to focus on this, yield curve play. The reality is you got to focus on transaction volume. So that's why JP and all those guys announced weaknesses. Look at high yield calendar. The high yield calendar slows down. The big banks in particular are heavily levered to their FIC businesses. So their fixed income rates and currencies business are what drives it. So when Doug and I are saying, hey, volumes are slow in those areas, that's when the big banks take a hiccup. You also have this lack of volatility impacting mortgage, so there's less refi. The banks still certainly the big banks make most of their money on transactions, not from net interest margin. The 2s, 20s, I've worked at banks. Banks hedge a lot of their interest rate risk. Banks blew up in the S&L crisis, and everyone kind of remembers that and says, oh, 2s, 10s. Stocks correlate with that fairly often because so many people look at it. That tends to be when you want the opportunity. So I wanted out of banks, a month and a half ago. I still want to be out, but I will watch for a turnaround where you start getting credit spreads wider again, where you can pick up, or you get some volatility back in the market, which will typically happen during recession. That's when I'd want to buy the banks.
But Peter, well, but what do you make though of the fact that financial stocks in the S&P 500 have given up almost all their gains so far this year?
I think they were way overdone because we weren't getting the transaction volumes. People also got way too excited about deregulation. I think the whole concept
which hasn't really happened beyond executive orders.
Right, and it's probably not going to happen. I think Volcker rule was a silly rule. It was hard to enforce. It decreased liquidity. People don't really understand it. A lot of the other rules are there. They make some sense. Maybe they were over the top a little bit. And you've now had 4 years of banks trying to implement those rules and adapt to them. I don't think there's going to be a big regulation change or deregulation for banks. So that people got carried away. Small banks, again, I think there's potential. I think small banks will be left a little bit more off the radar screen, but the big money center banks, they aren't going to get this huge regulatory reform. And I don't even know if they did, if it benefits them that much today or tomorrow. And
David, when we talk about recession-proofing your portfolio, obviously gold has to be part of it.
It's our wheelhouse. The truth of it is what we've been talking about here with Doug and everything is, okay, if the dollar is going to get weaker versus the euro versus the Chinese RMB versus the yen, if all of these things are in play and we're on some sort of a weakening process to try to stay out of recession in different countries, they're all trying to weaken their currencies versus each other. The one currency they don't manipulate is gold at this point. And so if you look at gold as a currency and not as a commodity and say, okay, gold is a currency it's traded like a currency vis-a-vis others. If you look at volumes and stuff, then you say, okay, wait a minute, where do I want to be? I want to be in something that's not controlled by one specific government, by one specific entity. It's global, it's worldwide, and so and it's also there's you don't have counterparty risk. Your gold is your gold. Your counterparty risk might be in valuation, but you don't have counterparty risk. You're not going to have the Fed printing gold. They can't do it. You're not, or the ECB taking it away. It's a very, very different animal, and that's why it's a safe haven, because in these kind of situations, it's a place to go to store your wealth, to store your capital, and it's worked for 5,000 years, and that's why it's still viable.
All right, so let's talk about
for one second. I just have to ask this because Bitcoin, it's every day. Where does that? Is it a currency? Is it an asset? Is it a commodity?
It's up 200% so far this year. Bitcoin is incredible.
I think Bitcoin, Doug and I have had some discussion. Bitcoin is a currency. And I think the reason Bitcoin has so much flavor of the month here lately is because it is an alternative currency. It is a way to get away from the dollar or the euro, something like that, and to transact. And so if people are moving money, then it's a way to do that, and to do that securely and safely. And so people are looking for that.
It's the
I'm
choice
not
of ransomware.
I understand, but
that's why it's so valuable.
Right. That's why it's been on such a tear.
Let's take a step back.
Okay.
On the ransomware thing, I think that's like, maybe 0.0001% of all transactions. When it comes down to it, ransomware was probably done prior in dollars, so we don't call the dollar something like that.
Right.
I think that Bitcoin is really about supply and demand. There's a limited supply. The demand has been pushed by marketing. Marketing has been fantastic, and the Bitcoin's been pushed everywhere. And now people say, I'll do a vending machine. You can buy your soda with Bitcoin. You can buy a car with Bitcoin. Gets a lot of press. So you have very limited supply. Demand has started going up all around the world, and there's more and more places you can spend it. And if you can spend it, then someone says, maybe I should get some
as
so
an
I can
alternate
spend
currency.
it. As an alternate currency.
But when we
now,
have
it's also used by, if you're in a country, China, for example, or maybe in Qatar today, or maybe you're in Venezuela, and you want to get dollars out of the country, but you can't do currencies, well, guess what? You can sell your Venezuelan bolivar, and maybe you can pick up some Bitcoin, or you can sell some Chinese renminbi, and you can buy some Bitcoin. So there's a lot of folks in other countries that say, I want to get out of my thing, I want to put some money offshore, and it's a great way to do it. It's not actually offshore, though. It's in your zip drive.
But when we have billionaire Mark Cuban tweeting that Bitcoin is a bubble, I mean, what do you say to that?
I don't. Well, Mark Cuban is a billionaire, but I don't think he knows everything about everything. I think because you're a billionaire doesn't mean that everything you say is correct.
I think it's a bubble.
You think it's a bubble? Why?
It's probably about the fourth bubble in Bitcoin, right? It has a habit of running up and coming in, but bottoming out a little higher each time. But it runs up, it comes in, it runs up. Every time there's a news article about, I know you don't want to talk about it, but about ransomware, it pushes it higher because all that demand that is created is on the buy side of the equation. So it's forcing the instrument higher. I don't own any Bitcoin myself. I'm too old. I'm not involved in that. I don't think it'll do you much good when you're in a dark alley with some guy's gun to your head. But it does exist, and it's going to exist for a long time. Either that or some other digital type currency that replaces it.
But if I'm worried about a recession and I'm trying to recession-proof my portfolio as we're talking about, I mean, do I look to Bitcoin? Is that a viable solution here?
I don't think so. I mean, I think that you're limited in terms of the liquidity, where you can certainly purchase it, when you can get out, how long does it take for you actually to purchase it, how long before you hear that you've bought it or sold it. So I think you're sort of limited there. Certainly on an institutional basis, you're very limited. There's an ETF that I keep on hearing about that's ridiculously overvalued relative to the underlying. So I think that you're very limited in terms of what you can do. So everyone can talk about it, and maybe everyone knows someone that owns 10 Bitcoin and sits there saying, man, I wish I was him. But none of us want to pay the offer.
And it's it's a unit trust, so that's one of the reasons. Unlike an ETF, which has create, redeem, so this unit trust that's out there is trading at extreme value. You cannot get a borrow on it, so there's been no borrow. I know some people have been trying to launch some ETFs. I think that got rejected initially, but people are coming back. So I think one thing I kind of view Bitcoin as an interesting thing. I think in some ways it's picked up from this wealth growth in overseas, whether it's China or other Africa, where the wealth's been trying to find a store of value outside. At the same time, there has been no effective way to short it. There's been so I think as you start seeing some instruments that allow people to short it, you might get even more extreme swings. So it has become, people are looking at it. Maybe it belongs in part of your portfolio. I'm still not convinced it's a currency or a commodity or a equity type asset. It's something. It's certainly, it's worthwhile taking a look at. but it hasn't really stood the test of time either. So I think we have to be very cautious about what's gone on there and how easily it's manipulated. But if our election can be manipulated by fake news, how easy is it to drive a
a good
cyber
point.
currency through?
That's,
David?
I agree with that point, Peter. It's okay. It's had a limited lifespan, and it is a cryptocurrency, and so we have very, very limited experience with cryptocurrencies. I mean, you might say dollars and ECBs are in this days of digital day, but that's where you get to base something on. That's where gold comes back into play, gold or silver or something, because that has a 5,000-year history. So all of a sudden, is it a currency? I believe it's a viable currency, but I also agree with Doug. It's extremely limited. The amount of it is extremely limited. It's market driven right now, and so do you want to use it as a safe haven? I don't think so. I think what I mean. It's got it's a different.
Too, right? When you hedge your portfolio, you do it based on a correlation. So if you can tell me the correlation between Bitcoin and anything, I'd be really interested to see
exactly.
it.
Right. Well, it's just too new.
There isn't one. It's like saying I'm going to hedge myself by buying a Rothko. Well, that's great. It goes up every year in price, but it doesn't mean that one day the bottom's not going to fall out of it.
But if we're talking right,
or maybe a central bank turns around and says, you know what, we're not going to accept this anywhere in our borders. Well,
shut it down.
Shut it down. The IP addresses are all closed down. You can't go in and buy it or sell it from that country. So there's a lot of limitations there. The fact that there's little correlation. It's sort of like we're all pointing to something that goes up every day, and we say, oh, well, that would be a good hedge for me. Well, that's not a hedge at all. That's not the definition.
So that's my point also, Doug, is to say, okay, if we're talking about a recession, we're talking about a recession coming, whether it's a mild dip or whether it's a huge, crater like I'm talking about. The fact of the matter is, if you're looking for some alternative investment or something away from your stocks and bonds or whatever, what are you looking to invest in? Bitcoin's not it. You would go to gold and silver. You go with something that has the test of time versus something new. So, and I'm not downgrading Bitcoin. I'm just saying that there's a time and a place for everything, and I think you have to be very careful about where where Bitcoin fits into that, at this particular juncture in time and space.
And I want to go back to gold for a moment before we got on the Bitcoin tangent, which was great. Within gold, I mean, are we talking the bars, the ETFs, the gold mining stocks? Define that for us.
I think you have. It's like anything else. We've talked to Jim previously about it. If we're going into some sort of a mild recession, the gold miners might do very, very well for a while. But the fact is that they are companies and they have earnings and they have managements and they have that. So they are equities, they are a stock. If you're doing just a straight safe haven play, if you're saying I want to store my wealth, then I would store it in gold, because your counterparty risk is extreme. There is no counterparty risk. It's your gold. So it depends on where you're at on the spectrum of your risk tolerance. And so, am I saying put 100% of your money in gold? No, I'm not. I mean,
what percentage should you put in gold?
I think it's got to be increased. I think now.
So 10% to 20%?
10% is probably a good point now. If we go further along on this, as we get further into the fall and maybe towards 2008, and we don't have a recession, I think that would increase. I mean, Steve and I talked about this before. He was in his own portfolio. You were at 3 or 5% earlier, and you went up to 7 or something. And I think that's a wise way to do it.
A sample allocation every once in a while. Right now we're at 7.5% on gold. We recommend that it's in physical gold. All right, we recommend 7.5%. It's never been lower than 5%. It's never been higher than 10%. So we pretty much do it in 2.5% increments, and we stay in that range all the time. I would think that if gold were to hit 1305, which is coming up soon,
we're about $10 away from
that's
1300.
That's either resistance or an accelerant. All right, that level. So if it can get over 1305 and hold the level, I think we go to 10%.
While we're talking about gold, just to go on a tangent beyond this recession, we have the Comey hearing on Thursday. Former FBI Director James Comey is testifying before the Senate Intelligence Committee. Obviously, when Comey has been on Capitol Hill before and when he was fired, gold spiked. So just as a short-term play, I mean, how do you play gold ahead of this Comey testimony?
Short term, I hate doing this, because I view gold as safe haven, as stored wealth, and so to play it on short term is kind of an anathema for me. But I would say, in the play, you buy before Comey talks, and when he talks, sell it. Just because you're gonna take a little out of
that with the ETF.
You're gonna do it. Yeah, do it with the ETF. Don't do it with physical. But if you're gonna do it, and that's actually a very good way to do it, because you can get in and out very quickly, and you can have those kind of moves and take advantage of some of those kind of moves that occur just in the short term.
And if Comey throws some bombshells on Thursday, I mean, what does that mean for your sectors, guys?
But I think that the odds of him throwing bombshells, if it means it's going to incriminate himself, are very, very low. And so I think that there's an excitement that's building in the mainstream press that I think is going to end up being a nothing burger,
Right.
as is used all the time.
So, but if
we're,
he-
we're
but if
getting
he's
really
boring-
excited about something. Well, it's not going to be boring. He'll certainly come up to the point, but then not actually say certain things. I think the reason he's coming and he's doing this right now is really to clear his name, because the way that he was dismissed wasn't maybe to his liking. And so he's going to come out, he's going to clear his name, he's going to show himself to be an honorable individual, but really give no data other than what we already have, that's sitting out there. So I don't imagine that we're going to see anything, because he's already said in hearings that he was never influenced. And whatever wanting him to say is, look, I was forced to do this, or I was influenced to do that, but he's already testified that he wasn't.
But those memos, if they do exist, would contradict the testimony he gave on May 3rd.
I can write a memo too. It doesn't mean it's true. I can go back to my office right now, I can write an email to myself, and I can say this, 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 and this. That doesn't mean it's true. That's a he versus she. He said, she said.
I mean,
and
Sarge?
it's,
how many times do you look at I write stuff down all the time. I don't know about you guys, when I'm trading, when I'm trying to make money, I write stuff down constantly. I act on so little of it. I'll be like, wow, good thing I didn't do that, Maybe that's what Comey's thinking.
But moving away from the memos, though, I mean, how are you trading this Comey testimony in your portfolio?
I have ahead of this Thursday, and it's not just Comey, it's also the UK and it's also the ECB. This triumvirate of risky possibilities, I have bought some downside protection. All right? I haven't really
Meaning?
changed my equity portfolio at all. But
So what
but
have you bought?
I usually sell options because it brings in revenue. I actually bought puts on my larger
Wow,
positions.
okay.
So I bought puts that are within range of the last sale on quite a few positions. So I spent a little money just making sure I don't lose a lot of money.
Okay, and then going back to this recession idea, we never got some FX picks from you in terms of how to recession-proof your portfolio. So give us some.
I think, on pure FX, I think it's hard. Obviously, a recession in the U.S. would then, it's like, you get a sneeze here, you get a cold for the rest of the world. And so everyone's going to have
That's a
some
good point.
difficulties. I think what I would look at, though, is I'd look at, how far is the U.S. overvalued relative to history, and where do overseas markets, where are they relative to history? I think you could probably argue that Europe's undervalued relative to historical highs, whereas the U.S. is overvalued. So maybe you'd sort of, take a little bit off of your U.S., maybe sell some U.S. indexes and buy some over in Europe. And that way you'll pick up, if the dollar does weaken, you'll pick up the euro move, but also then it's you're playing this long short move in terms of valuation, but across borders as opposed to just in the United States. And that way you'll pick up the dollar move too. So I sort of like looking at equity markets in a very broad swathe right now, because I think that there's a lot of equity markets that are undervalued because of the whole, Greece is terrible, Europe's going to break up type thing, especially in Europe. And at the same time in the US, I think there's a lot of flavor and air that's in the market right now, caused by excitement and exuberance that's really more of folks just buying it because it's going up in price, as opposed to their reality when they look at where are the earnings behind this.
How does the dollar typically perform during recession? Is there a broad-based kind of trend we can deduct?
Well, it really depends. If you looked at 2009, you saw the dollar, you saw a big weakening of the dollar when the euro went from 110 or something, I think it was up to like 150, and then it just started coming back down again as soon as you got into QE. And so I think that we're looking at it in terms of, certainly at the onset, you'd see probably a small strengthening of the dollar if the dollar is seen as being a flight to quality. I think these days, though, it's maybe not necessarily so. When the gutter news came out over the weekend, you didn't see the US start to do well. Instead, you saw the euro do well. So I think that people are shifting their portfolios towards Europe and seeing Europe as being sort of a safe harbor right now from uncertainty policy in the US and way too much fixed income, and no one knows what's going on in Japan. And so Europe is the safe harbor, in my view, in this media storm that we have. I like the euro.
Well, and that's a great point, because the European economy has outperformed the U.S. economy for the past 2.5 years. So let's go around the table and get more insight on Europe versus U.S. stocks when you're thinking about how to recession-proof your portfolio.
I think you still want to be mostly in U.S. stocks. I mean, you might give up a little bit of upside, but if things get real ugly, your downside is probably less severe also. Maybe that's just an ugly American speaking, but I think that when there is that flight to quality in the most nervous of times, that the U.S. will retain some shred of safe haven in that scenario, but you're going to have to be in the right stocks. You're going to have to be, like I said, in dividend yielding stocks. Maybe outside of that, maybe infrastructure names, defense names, something like that.
Are there
'cause that's where
specific
spending
names
will be.
that you think are recession-proof?
No, nothing's recession proof. But if you if you think the government's going to be forced to spend money to keep the economy afloat, well, then you want to be long your General Dynamics, your Raytheons, your Lockheed Martins, your Boeings. You want to be long your Nucor Steels, which I am long, your AK Steels, your U.S. Steels, your U.S. Concretes, those kind of names. Builders and defense is where the money would flow in the first tranche.
David, what's your take on Europe versus U.S.?
I think I'm kind of with Doug. I would expand it a little bit, and I would say that it's not just Europe and the U.S. You have to include in any kind of discussion like that. You have to include Japan and China also, because those are the large trading blocks. And so I think China is a they've got huge problems, much bigger than ours, much bigger than Europe's. Japan has huge problems. So I think that you have to evaluate it vis-a-vis those trading blocks also, and I think Europe's in a very good position. I think we are also. I think when you talk about recession, recession occurs because there's been a tremendous amount of malinvestment, and then you come down to where you have concrete, solid investments, and then you build off of that again. So the question becomes, in the last 8 years. Is there more malinvestment in the United States and in what we've done, or is there more in Europe or what they've done vis-a-vis China, vis-a-vis Japan? So I think the greatest amount of malinvestment has been in China. I think without a doubt. So they're going to have a huge problem. Then you say, okay, well, where's the next place that's going to occur? And I disagree with Steve a little bit. I don't think you go to, when you're talking about specific areas, I don't think you go to where the government can bail us out, because I think the government has spent a ton of money already. They're not going to be able to next time around. So I would go to your staples like a Procter & Gamble and Johnson & Johnson, where you say, okay, those are. You
got to buy toothpaste.
You're going to buy soap and toothpaste and so are they going to be hurt? They absolutely are. I think they're all overvalued right now. Equities are overvalued in general, but I think they'll be less hurt than others. When it comes to Europe, I don't even want to venture a guess, because I know a little about some of the European banks and stuff, but their economies in general I think they've suffered through much more than we have in the last 4 or 5 years, especially places like Italy, Spain, Greece, obviously, and so I think their economies might be. I don't think they'll take as large a hit, because they haven't grown like we have. They're starting from a different base.
You said equities are overvalued, and I want to go right back to that in a moment.
Okay.
But one more question on Europe. The unemployment rate in the Eurozone, 9.3%. It was at 12.3% in 2013. Isn't this whole recession question also about runway, right? How much room is left to go? I mean, we have a 4.3% unemployment rate here in the U.S. Isn't it better that they're a little bit higher and they have some more room to come down? Wouldn't that be a nice, trajectory for stocks?
Yeah, I think they've got more room to come. They've got more room to run. They also, you go through the replacement type thing, where the U.S., right, we had 4 years of deep recession, and then people start, okay, shoot, I need to buy a new suit, I need to buy a new shirt. So you can only kind of avoid purchases for so long. I think Europe's just coming out of that phase where people held off on buying a lot. So I think there's opportunity. I actually like the European banks. I think today something really good actually happened in Europe. So Banco Popular, which was a Spanish bank, effectively got taken over for a euro. So it was almost like when Bear Stearns got bought by JP Morgan, right? They wiped out, in this case, they wiped out all the equity, they wiped out all the lower tier debt, but they kept the senior unsecured debt fine, and they kept the depositors whole. And so Europe has always talked about this, wanting to, make everyone pay for the mistakes. And somehow that always translated that there was a risk to senior debt holders and, actual depositors. I think that gets taken off the table, which I think is actually very good for the European banking system. I think if you're going to look at doing banks, you have to do at least what we did, which is make senior unsecured debt and depositors, sacrosanct unless it's such a disaster. And they really, I think, did that to some extent today. So I think it's going to take a little bit of time for this to filter out. People will talk about what happened to the COCO bonds or these weird subordinated debt or the equity. But the real story here is protecting the senior debt holders, which I think gives a lot of room for European banks as a whole to do well.
David, you mentioned earlier that you think U.S. stocks are overvalued. We can't ignore that. So take it away on that front.
I think that after 8 years of bull markets and Europe, at the valuation levels we're at, I think they're tremendously overvalued. So you can go. I mean, we've been talking about earnings and that kind of stuff, but and price earnings ratios and all that. But you wipe out some earnings, and your price earnings ratio goes to nothing. So at a certain level, I think we're due. I think the time has come. We're due. It's a natural cycle. The Fed has truncated that cycle in the past, for several cycles now, and I think that I don't think they're going to be able to do it this time. I think that this time, and that's where we have some disagreement. But I think this time around, I don't think the Fed's going to be able to control it. And when they do it, and then we'll see where the real valuations lie.
Sarge, do you think stocks are overvalued here?
Not as much as everyone else. I think that they are somewhat fairly valued for the environment.
So what does that mean?
That means that if you can't make a buck anywhere else, then there should be a higher valuation in the one place where you can make a buck. So it increases demand. So the whole equation is changed. Where, yes, by historical measures, yeah, almost every way you look at it, we are overvalued, but maybe that's not the way to look at it. Maybe if the Fed can successfully tighten monetary conditions and not throw us into a recession, if the other central banks can do the same, well then, yeah, we're overvalued and we're going to have a sell-off. But if they can't, if they fail, well then we're in the right spot and we're probably going to go higher. Maybe after some turbulence, but we're not. What are forward-looking earnings right now? Maybe they're still like 19. 19 times, maybe 27 on the past 12. So it's not insanely crazy yet. We've been here before, under different circumstances, and there's probably still some upside, at least for a quarter.
But isn't it also true that a lot of the earnings growth we've been seeing in U.S. stocks came from the companies that have a lot of exposure overseas? So isn't that kind of a worrisome sign?
That's definitely a worrisome sign. Although now China's going down that one path, one road stimulus, road building, seafaring package, that's going to be massive, all right? That's going to create demand for the services of a Caterpillar, of steel companies, I'm losing my mind here, but
okay. What do you guys think?
It's only
Are we
gonna be good for
overvalued?
Caterpillar and U.S. stocks if the Chinese say, hey, do you want to build it? Because otherwise it's great for China.
Right.
And the U.S. hasn't done much right now when it comes down to negotiating.
well, it's great
on
for
that
demand
point.
for oil, too. And now President Trump's talking about infrastructure.
Finally.
If he gets, now I know he's not very good at getting his deals through or his ideas through, but if we ramp up infrastructure and the Chinese are ramping up infrastructure, well then all of a sudden the whole demand equation changes for all these commodities.
So guys, do you see a sell-off in stocks coming? And by sell-off, it could just be a couple of percentage points, which would still put us at pretty high levels.
Well, a couple of percentage points, sure. You could have that, in the next
Tomorrow,
20 minutes,
right.
and then you'll have
Right.
this buy in the dip thing come in. What you have seen in fixed income markets and in equity markets is you see these dip-offs, and 2 to 3% really from the levels we are today. I think everyone would agree that should happen. And then you'll find central banks come in and swoop in some ETFs that'll prop up the market around these levels, and folks will come in and start buying again. And in fixed income market, like in the treasury market, the Chinese have just come out and said, we'll start buying U.S. treasuries again. So there's support for both asset classes by central banks. So if you're looking for the 2 to 3%, sure, a 20% drop, I don't see that happening at all.
I think that's far more likely than Doug does, only in that I think one of these buy the dips fails. And I think this system right now is so obscure where you have algos chasing crude oil versus VIX versus this ETF. So every purchase of Apple triggers a purchase of QQQ, which purchase, a sell of. I think the system has become very, very complex. It used to
distorted.
Right, and it used to be algos really kind of picking up our mistakes. Now it's algos trying to pick up the mistakes of other algos. So I think we are at almost a tipping point in terms of these markets are too fast, too correlated. No one completely understands them. As we talked about last month, the SEC approved 4 times levered ETFs. What do we need a 4 times levered ETF? Where's the benefit? So I think that, I'm not sure what triggers it, but I would not be surprised to see a fairly large flash crash type scenario. We've seen them with relatively degrees of frequency. I think the last one in the equity markets was August 2015 when China. The treasury market one, I can't remember, it was before or after that, but we live in such a world where people have come to expect a certain degree of liquidity, but that disappears, and when it disappears, it tends to disappear quick. And as you've always said, it's always easy to find a seller at some price, but not to find a buyer.
Right, the buyers don't exist. That what you brought up, Peter, I think is very interesting. We have been conditioned since Alan Greenspan to buy the dips. Because why? Because the Fed intervenes. Because the government comes in and says we're not going to let this go too low. So go ahead and buy the dips. We've all been conditioned to buy the dips because that's how you make money. Look at my buddy Steven. And he's absolutely right. That's how you make money. So that does not mean that that can continue forever. Nothing goes in a straight line forever. And so at some point in time, if buy the dips doesn't work, and all of a sudden you go down, say you go down 5% or 7%, and it's okay, buy the dip time, and everybody's algo kicks in, and everybody wants to buy the dip, and all of a sudden it doesn't work, and now you're down 10 to 15%. Now you have an issue. Now you're like, okay, who's running for the door, and where is the buyer? And is the buyer the central banks? Do they have the capital to buy? Are they going to be able to create the capital to buy? I mean, 2008 was a huge anomaly, and that took a tremendous amount of governmental intervention to get that money, those monies out there to intervene. Can that happen again? Will it happen again? I think the risk is huge, and people just don't recognize it. I don't think it's being accounted for.
So all the more reason to buy gold, to kind of hedge yourself against
I would
this
say
distortion.
I'm talking my own book here, but the answer to that is yes. To say, okay, to take advantage of that distortion, because gold has not. Last year at this time, gold was trading right around here, $13.50 or something. It was basically around the same price. So has there been a huge rally in gold? No, we've had a nice rally this year, but gold had a good rally last year, and then it traded off at the end of the year with the Trump. So the truth is, you have to find undervalued assets. Getting back to a point, Paul Singer, you're talking about Mark Cuban making.
Sure.
Paul Singer came out and he just created a $5 billion cash fund that he has not invested. The news came out this past week, and why? Because he sees a major dip coming, and he wants to be able to take advantage of that pricing mechanism. Now, he's not talking about 3% or 5% of the stuff they're talking about. He's talking 15, 20%, something like that. So if that occurs, that is a big shock to the system.
Sarge, weigh in on this cash point.
Well, I see the case. I'm not blind to it. I try to, by hedging myself somewhat through 7.5% gold, through 15% bonds, I hopefully hedge myself enough where I'll be able to absorb a shock. But obviously in that situation, you're going to be hurt. You might be checking for your clean water and your ammunition and your canned food instead of checking your portfolio that day.
You should be doing that.
See, I still don't believe in there's a difference between a doomsday scenario in the financial world that we all live in and a doomsday scenario. Yes, it's going to be difficult. Yes, it's going to be tough. But there's malinvestment and investment. I think we're inundated with malinvestment lately, and that has to be corrected in the system. But that doesn't mean there's not good investment out there also, and that there's a floor and a level which we grow off of again. The problem is no one wants to endure the pain to get there. So is there going to be pain? Yes, but just because there's pain doesn't mean we run for our semi-automatic weapons,
our
which are illegal in this state, by the way.
No, semi-automatics okay.
No, not okay.
Conversations with
Yes.
people, I find this almost fascinating. At the institutional level is most people are probably legitimately underweight the FANG stocks. They do not have full exposure. So people look
Is
at
that a
and-
mistake?
Well, it's just a very hard thing to manage because you're underweight, yet it's the single largest position in your portfolio. So you're dealing with P&L swings much greater than you've ever seen. It's a very tricky thing. This happens often in the credit markets, and you saw it in the high yield markets, where you have these huge, large exposures. Companies are 6, 7% of the index, and the next one's 2%. And so say you own 5%. It feels like a massive position, but you're still underweight, and I think it creates it's a very difficult thing to manage for a lot of equity guys. When you're used to trying to benchmark the S&P 500 and the biggest couple stocks are 1 or 2%, okay, you can manage around that. You can choose to be underweight, overweight, and all your positions kind of look normal to you. I think it's just very weird right now where you have some huge outliers in terms of the percentage they represent in some of these indices. Investors are underweight, which is, I think, one of the bull cases, right, that they're going to have to get up to weight. At the same time, you see larger P&L swings than you've ever seen in a single stock because of that just large position side. I think it's going to take time for people to adapt to what's going on to these indices where they don't really look like an index used to.
I just
Sarge,
sold my
you want-
Amazon.
Yeah. What do you think there's more upside in FANG?
Well, there certainly could be. You can't bet against them. But Amazon happened to hit my price target. I sold it. It's gone higher after that, but not much higher yet. I would like to get a dip in Amazon so I could buy it back. I'm also long Apple, which I have not sold yet because Apple is not behaving like the others. If you look, Apple got a negative MACD crossover earlier in the month, and it went sideways after that. And this fancy show they put on the other day.
Yeah, the Worldwide Developers Conference, not that much out of that.
I mean, come on, give me a break. Other guys are selling this stuff already. I know you're nice and you're pretty, but we're not getting fired up. So I stay long Apple for a little while. We'll see what happens.
Okay, before we wrap up here, because we have about 5 minutes left, I want to shift gears a little bit and put all this into further perspective for our viewers. Once we are in a recession, and that day will come, what tools do central banks have to save us and the markets? We talked a little bit about it before, but let's just get one comment from everyone. Sarge.
Right. That's why I think they're so hawkish right now, okay? Because they smell this trouble in the water.
They want some dry
They see
powder.
it coming, and they don't want to be in a position where they really can't react. They want to be able to react, so they want to get interest rates higher. They want to get the balance sheet down because they're going to have to take interest rates lower, and they're going to have to jack the balance sheet back up. So obviously, they might be trying to portray it as confidence, but it smells more like fear to us. I think they're afraid that this recession will come before they're ready for it.
All the more reason to start on the balance sheet.
I agree with that assessment. I think that they're looking out and saying, okay, we have to be ready for the next move. Now, that being said, they've opened up since 2008, the toolbox they've opened up of levers that they can pull between QEs and interest rates and TARPs and negative interest rates in Europe and all. It's an extremely powerful array of tools that they can use, and so I think they definitely will use them all. I don't see. So we're talking about recession and everything. I can see them coming in and putting a halt to any recession for a while, buying a dip sort of thing, and then I think we see where we go. But I think they will definitely use every tool they've already used and then some. I see U.S. can go negative interest rates.
But really?
I hope that doesn't happen.
I do
I've
too.
hated negative
I do
interest
too.
Do you
but
guys think that this promise that interest rate cuts are a solution to boosting growth, has that kind of waned now that we've had near zero interest rates for almost 10 years?
I think there's been some enthusiasm has dampened for negative interest rates. And certainly extreme negative rates don't seem to have the following they did. But again, there seem to be, like everything else in the economics world, some people are pro or for it. I ultimately think at some point they resort to just handing everyone checks or something.
So
like that.
helicopter money.
Helicopter money.
True helicopter money. I think Bernanke would have liked to do that. He just never got to.
Doug, what do you think? Helicopter money?
Well, helicopter money is like the basic income that essentially Zuckerberg was posting about last week, where he said, and it's been tested in some countries or some towns that not in the United States, where everyone should get X $1,000 a year or a month so they can survive. And then on top of that,
Because robots are taking our jobs.
Oh yeah, to an extent. So certainly at some point maybe we'll get there. But right now the Fed's sitting there. They've got a couple in the chamber. They can always take those out the chamber, because when you put something in the chamber through jawboning, it means that the market prices in interest rate rises. They can start taking them out. They can go from hawkish to dovish. That's step one. Once they go dovish, then they can cut rates. They can cut rates again. Then they can start talking about negative rates. So all these is maybe 4 or 5 different machinations they can do without touching the balance sheet. Then they can turn around, they can say, you know what, we're not only going to start reinvest, we're going to do a little bit more as well. We'll get QE 20 or whatever it's going to be.
Whatever it is.
We'll do that. If that doesn't work, then they go into negative rates. They can do a TARP program as well, take some bad stuff off the balance sheet. There's plenty of things that the Fed can do. But I think that's why, certainly in the old days when we would sit around and the Fed would raise rates, they'd come out and they would do it hard. It was like, inflation's going up, we're raising rates. Let's stamp down inflation.
Right.
Or we're growing too hot. We're raising rates. These days it's not. It's sort of like we're not growing at all. We're raising rates. You can feel the fear. You can smell the uncertainty, and the fact that they feel like they have to do it. But it's no way like the old days when they cut rates aggressively or they raise rates aggressively to stop something from happening. And we're not stopping inflation right now, and we're not stopping growth. So the only reason we're raising rates is to try to put some more chambers in the gun.
All right, we have 2 minutes left. I want to end by having everyone give us one piece of advice until our next trading strategy session in July. So Sarge, let's start with you.
Well, I mentioned it earlier. I think it's probably, although I'm not calling for big trouble, it's time to be prepared for trouble. So I would definitely have some downside protection, whether you do it through buying puts or hedging different equities or debt products. I think you definitely need, or Dave's gold, you definitely need to have a plan for protection. You can't just say, oh, this looks all right. I think I'll be okay if something awful happens. Yeah, you have to correlate each protection move toward an open position.
David?
I think I agree with Steve, only I'm a little more